Are you a dentist looking to build wealth, maybe create passive income, and be able to eventually step away from the chair? Are there things that you feel like you should or could be doing, but you just don't know where to start? Hi, I'm Jonathan Moffat, a wealth strategist who's built and sold an 8-practice DSO. Now, I help dentists align their practice success with their personal financial freedom. Each week on this podcast, you'll discover strategies to boost your practice profitability, multiply your wealth, and transform your dental career into the lifestyle you've always dreamed of. This is Dental Wealth Multiplier. Hi, and welcome to another episode of Dental Wealth Multiplier. I'm Jonathan Moffat, and I have with me today a very special guest, my brother Austin Moffat, who is the managing partner at DSO CFO. And today we've got an awesome topic we're excited about talking. It's actually something that I get people talking about a lot recently, which is around profitability and how do we operate our practice or even grow or even scale, right, without the stress and without having that stress. And so today we're going to talk about kind of some best practices. We're going to talk about smart budgeting for growth so that you can grow your practice or your group of practices without that stress, and talk to you about some best case scenarios and some case studies of clients that we work with who've done this very successfully. So Austin, welcome to the podcast.
Yeah, thanks for having me. This is a great topic. Excited to get into it.
Yeah. So as we kind of think about this topic, again, I'm sure like you, I get almost every day I'm talking to a doctor about, hey, we're seeing profitability is lacking, or it doesn't feel like, the biggest thing I'd say is they're like, it doesn't feel like we have any money left over, or I'm watching my bank account, right? I'm keeping an eye on my bank account.
Mm-hmm.
If we were going to break it down into maybe, let's say 3 kind of takeaways or 3 maybe best practices or things that you absolutely should be doing to reduce stress, to make sure that you're looking and handling your financials or budgeting or kind of the financial aspect, operational aspect of a practice in a way that will help the owner reduce stress. Like, what are some of those things that come to your mind?
Yeah, it's a great question. And I think every business owner goes through this, not just dentists and practice owners, but for me, in doing this for several years, I think the biggest things are you reviewing your financials on a monthly basis, or at least just a regular basis, but at least a monthly basis? And so that's one. And then B, do you understand your financials? Do you understand what's taking place in your business from a financial standpoint, right? Okay, if I'm feeling like I don't have a lot of money, like my bottom line is showing that we made $20,000 last month, right? But I'm not seeing that in my bank account, or we made 40,000 or 50,000 or whatever, right? My bank account isn't showing that. So the math isn't mathing, right? So are you understanding what's happening in your financials in that aspect, right? Look, there's a couple of answers, or there could be a couple of reasons why, right? What doesn't show up, not to get too in the weeds and nerdy on the accounting side of things, but your principal loan payments or your owner draws, for example, or even dental equipment or furniture or any leasehold improvements, for example. Some of that stuff that probably is a little pricey, a little expensive, especially hits the bank account or the credit cards fairly heavy. And some of that stuff doesn't show up on your profit and loss statement, right? For a various of reasons. So that could be an answer why your net income is showing, 40,000 net income bottom line, but your bank account is showing maybe 18,000, for example, right? And I think that's transparency that needs to be conveyed to the owner doctors, right? Net income and cash flow, not to get confusing, they are not the same thing. Unfortunately, they're different things. So number 2, right, for me is, do you understand what's happening in your financials? So then number 3, in my opinion, is, do you have goals, right? Do you have goals that you are tracking and that you're following and then holding others accountable, yourself and others accountable, that you can, that you're reviewing in your monthly financials or your profit and loss? So that could be revenue goals, right? You have a goal of doing $150,000, in revenue a month. Are you tracking that? Right? If you are doing consistently below that, say you're doing, $20,000 consistently below, your revenue goal, are your goals realistic? Yes or no? Are you Are you meeting with your team members, your producers, your associates, your hygienists, right? And meeting with them and making sure that they're buying in on the goals, right? Are they too high? Are they too low, right? So that's just one example. And then, you can kind of go on the expenses from there on. Do you have a goal as to how much you should be spending in dental supplies, lab fees, marketing, payroll, right? Do you have those goals in place? Yes or no? And it's okay if you don't. We can maybe touch on a little bit today, maybe a good starting place. So, anyways, not to get too far into the weeds, Jonathan, but I think those are the three things that I would heavily stress, right? It's one, are you reviewing your financials, regularly, at least monthly? Two, do you understand what the heck your financials are saying? Are they telling a story that is realistic, to you and makes sense to you? And then three, do you have goals that you're tracking on a regular basis?
Okay. Yeah. So I just was writing some of those down so we can make sure we hit all those.
Mm,
So as you were talking there, it made me, I thought about a joint mutual client that we have, and
yeah.
they've got 4 practices. They kind of gone through, I think, probably a typical cycle for groups that we see that we work with that go from like 1 practice to 2 to 3 to 4, right? There's this kind of, I think, this natural progression that groups go through. And they were working with a consultant and they were kind of doing a lot of things right. And then it was like, they weren't understanding, they weren't getting the right reports from their accounting group. They weren't
Mm,
really reviewing them. The doctor, I think, thought that they had a really good understanding of what was going on financially, but for whatever reason, wasn't looking at the right numbers, right? A lot
mm,
of things weren't happening that the doctor, I think, thought were happening. And all of that kind of came to a head Q3 of last year. And they found themselves in a really actually bad position where they were like very low cash flow, dipping into personal savings to keep the practices afloat, looking back to banks for lines of credit to again keep the practices afloat. And so around Q4, they're like, "Hey, we want to start working with you guys." And we're like, "Yep, let's take them through the process." So like maybe we just kind of talk about that process a little bit, and then we can talk about like the success that they've seen just in the last 4 months. In fact, I just met this client earlier this week, so these numbers are fresh in my head. But the first thing we did was we looked at their past prior experience, performance of the practices, and we created a budget forecast, call it a budget or forecast, but for 2025, basically saying, okay, this is what the practices did historically.
mhm.
What do we think they can do 2025? And let's forecast that out over the next 12 months as far as revenue that we want to hit. So the goal of revenue we want to hit, expenses, and then ultimately what drives all of that is what's the actual bottom line net income or profit that we're shooting for the owners, right?
Right.
And that's ultimately, in my opinion, the most important number. That's what should drive all the other numbers, is that number right there. You've heard me say this before, especially around like, KPIs or setting budgets. A lot of times in the accounting world, you hear this acronym BAM, right? Bare Ass Minimum, BAM,
Mm,
BAM.
mhm, mm.
And I always, when I speak, I'm like, it's kind of like the dumbest thing I've ever heard, right? Because you're like, how many of us go into business? Like, I'm going to go start a business so I can make the bare ass minimum, right?
Right.
I'm betting
Right.
not a lot of people, like, that's their goal. So if
Right.
that's not your goal, why would that be something you measure? Now, look, I understand it's like, what's my break even? Okay, again,
Right.
that's fine if you want to track your break even, but you better make sure that your personal revenue goals that you need as an owner operator or as the owner of the business, you better make sure that revenue or that desired income is built into that break even.
Right.
Otherwise, you're going to find yourself in a situation where every month you're like, yeah, I'm paying the practices bills, but there's nothing left over for me. Right.
Right.
And so I was thinking about that, and then kind of this mutual client that we started working with together, Q4 of last year. And so what I think is cool about that is you did a great job of building a budget, a 12-month forecast. We had
Mhm.
like couple meetings with the client to get that dialed in. And then we were like, perfect. Then they hired a new consultant. We shared that budget and like those forecasts with the consultant, right? They're like, perfect. They put all that information into their dashboard that they're tracking their dental software. They got the team on board. This is the goal. And then they would have regular reviews of those financials, those goals. So weekly, right? Most people look at their financials monthly. Well, that's what my accountant
Mhm.
is. That's fine. That's fine to do the full review, but like there are aspects of the plan I think you should be reviewing on a more regular basis. And what we've learned, having seen the success of, there's a pattern of success, right? So the clients that we're working with, that you're working with, that have, like, we'll get into to our client, and really well, who they have a 30% EBITDA or 30% net income, uh,
Yes. Yes.
and they have 8 practices. 30% is
Yes.
unheard of, right? We'll
Yeah.
get into kind of, but there's this pattern that these people, that these doctors, these groups have, and that they implement, that it's just like, if you do this, you're going to see positive results, right?
Right. Mhm.
And so I think, to your point, like, they had a plan, put that plan in place, regular reviews. So you meet and you do like a full financial review. How often with them?
Well, it's kind of, we have a couple of we do like a full set at least once a month, like full on. So each of the locations is like a full on month. And then on a weekly basis, we review their cash flows with them. Right
Yeah.
now they're a little bit more hands-on, right? But that's okay. I mean, that's what they hired us for. That's what they wanted, and that's what we can certainly deliver. So then it's on a weekly basis. It's actually a little bit more than that, because we actually then communicate throughout the week on Fridays. On Fridays, we send out reports to them as well to pay themselves management fees, which we can touch on in a little bit, which is new to them, new in the last quarter. Right. Again, a financial goal that we set with them. And anyway, so we're talking to them a couple times a week, right? Touching base, and they're pretty dialed in as to what's
Right.
going on in their practice from a financial perspective. But it's
Yeah.
pretty hands on.
Yeah. Just to kind of give a little background there, because you mentioned it, like, they weren't paying themselves a management fee, right? They weren't paying themselves anything really. And they
No,
were dipping into their savings to keep the practices afloat. We
correct.
implemented this system that we know works, which is create a plan that, based off of historical numbers and where they want to be, forecast that out in the future, measure that at least monthly, but with cash flow check-ins on a more regular basis.
Yeah.
And all of a sudden, now they're paying themselves by the way, their management fee is 11%. So they're paying themselves 11% management fee. They've been paying themselves that consistently now over the last few months. The other really cool thing is, we were looking at their numbers. Like I said, I had a call with them earlier this week, so these numbers are fresh. We pulled their 24, basically their rolling 12 months. So that'd be like February of 24 through February of 25. And their net income was -8%, -8%. So that was their net income. Then we looked at the last 6 months, and it was like almost break even. And then I was like, okay, what about the last 3 months? So
Yeah.
since we started implementing these systems, what has it been? They were 17% profitable. So
Yeah.
they went from a
It's insane.
-8% profit to positive 17% profit. And they're looking at their goals, they're mindful of where they are, they know exactly where the cash flow is. They're getting weekly financial cash flow projections from you, saying, this is how much is in the bank account, this is what payroll is this week, or this is what your loan payments are, or this is when rent is, and this is how much is left over, right? Which, again, as a business, you need those reports. Like with our group, with our 8 locations, I had those weekly. Every Monday was that meeting for me. Every Monday, I'd get on the phone with Austin and someone for your team. I'd have my regional manager there with me, and we would go through all of our practices, and we'd look at the cash flow. Like, okay, what do we need to collect? What did we collect? What didn't we collect? We'd go over those key numbers for us. And that's, if you're not looking at those numbers, in my opinion, on a weekly basis and analyzing that, then you're not serious about growing or running a profitable business. You should be looking at those numbers. Now, you and I were kind of talking before the podcast, and we're like, okay, do you always look at those numbers? And I'd say this. Many of you know there's a podcaster, kind of business guru, Alex Ramosi, probably from Erdem. I was listening to him a few weeks ago, and he said, he's like, I used to check my bank balance every single day. He's like, you want to know when I stopped checking my bank balance every day? Is when I had, I think he said $20 million in the bank. Then he's like, once I had 20 million, then I stopped checking every day, right? And then it's like maybe every week or every month or whatever. The point is this: if you're feeling the pain, or you're not in a place where you want to be in your business from a cash flow standpoint, you should probably be checking the bank balances every single day. At a minimum, I'd be in there every week, understanding, okay, where are we? What needs to happen? What's working? What isn't working from a cash flow standpoint, from an expense standpoint, from an overhead standpoint, right? And so maybe this is a good lead into like KPIs, right? Because key performance indicators, budgeting, like all that, you're going to have certain percentages within your budget of what you want to hit for those. So talk to us a little bit about what we see for as far as like best practices around the KPIs and setting those.
Well, yeah. I mean, let me talk on the KPIs for 2 seconds because I think there's a level of understanding as to the KPI. So look, here's what most practices should be tracking, and I'll give you the percent out of 100 of what these are and why it's so important. So yeah, you want to start with revenue, right? Now certainly a KPI, right? But that's an internal goal, right? So that's something that you absolutely 100% should be tracking on a monthly basis. I would go as far to add, if you're on cash basis of accounting, and that what that means is simply just reporting what has come through the bank, right? And just speaking specifically to deposits, that's just what was deposited in a certain period of time, i.e. month, right? And so if you have a goal of producing $150,000, right, but you're consistently collecting about 130, 135, 140, whatever $1,000, right? Then you're consistently collecting, below what your production goal is. Now that's a direct indication of collections, right? That's a separate discussion, but that's going to accrue over time, right? So that's, anyways, without going too far deep in the weeds on that, that's absolutely something that you should be tracking. For our clients, we actually customize that line item on those that are on cash basis. We actually go in, we'll pull the numbers from their practice management system, and we'll enter what like the net production. So like after adjustments and write-offs, what that is, so that they can know, hey, you produce X, but you only collected X. That means that you should have $10,000 or $15,000 more in your bank account, right? You track that on a monthly basis. That's just straight EBITDA. That's just straight money in your pocket. You've already paid. You've already done the work. You've already paid the overhead expenses. You've already done it all. That's just straight money dropping in your pocket at the end of the day. So without going too far in the weeds on that, that's KPI number one, right? Number two is this clinical expenses, right? So that's dental supplies and lab fees. Now it varies per practice, per group, per business model, but generally speaking, you want to be about 6% of your revenue on dental supplies and 5% of your revenue on lab expenses. Now, again, that varies, right? Per practice, per strategy, right? So that is just 11% in just those two areas. Okay, so that's 11% of your revenue, boom, out the gate on clinical expenses. Okay, let's go down to marketing is your next KPI. Again, based on your business model, your business strategy, but you want to be somewhere between 3 and 5%, depending on, what your goals are. So let's just be conservative and let's just call that 3%, right? So there's 14%, right, of your revenue in just clinical expenses and marketing. Okay, let's jump straight down to the big one, payroll. Okay. Now, you should be no more than 50% of your revenue on payroll. Now, that does include associate wages. That does include owner doctor as well. Absolutely, that does. I mean,
Owner
doesn't
doctor
matter
if they're clinical, right? If they're actually in there doing dentistry, right?
right. Yes, correct. Correct. But you can break that down, and I'll touch on that for 2 seconds. Again, it varies, but generally you want to be of that 50, 20% of that is associate wages, 10% is hygiene, that's 30, 8% is dental assistant, 7% is office manager, administrative wages. So there's 45% right there. And then 3.5 to 4% is payroll taxes, and then the rest is like payroll fees and a little bit of fat. So that was probably TMI, probably on the breakdown, but that's how that's broken down. So now you've got 14% between clinical expenses and marketing, right? And then add on another 50 to that in payroll. So now you're looking at 64% of your revenue out the gate in those three categories already, right? So again, that's why they're key performing indicators on your financials. Another one is rent, right? So rent is obviously a big expense. It's fixed. You don't want to exceed 6%. So you're like, well, how is that possible? It's a fixed expense. Well, it's purely an indication of your revenue, right? Are you doing enough revenue to justify the space that you're in? Yes or no,
Yeah.
right? So that's really what that is. So anyway, so now you're at 6%. Now you're at 70%, right? You're at 70% of your revenue in just those areas. And that doesn't include office expenses, internet expenses, dues
Travel.
and subscriptions, travel, continuing education, any legal, should you have any legal, right? Any professional fees if you have a consultant, right? So like it doesn't include any of that stuff, meals and entertainment, right? And so that's why those KPIs are so important to A, have, and then B, track, right? It's so key because if you're not, then how do you know if you're fat in areas where maybe you shouldn't be fat, right? And
It's
if, look, go ahead.
no, go ahead.
I was going to say, look, I mean, what's awesome about that is that we have a couple of clients where they crush it on their budgeting, right? That I'll just use that group that you mentioned, Jonathan, our client with the eight locations that are doing about 30% in EBITDA. Like they are consistent month over month in all their practices. Their model is so awesome to watch. In fact, they're one of the clients that I go to, excuse me, that I prepare my monthly meeting for, and I go, okay, well, what can I learn from them, right? Which is pretty awesome because that's it's a little unique in that regard. But they crush it. I was just reviewing their financials yesterday as we're preparing to close out February for them. I was reviewing their stuff yesterday. I'm like, holy moly, they did about it's like a little bit close to 4% in dental supplies, right? In the month of February. How did they do that? Right. And I'm like, you know what that does is that allows you, if you're consistently like performing better in some of those areas, then you can actually either A, take a little bit more of a draw as an owner, right? That's an option, which is pretty awesome, right? Or B, if you want to invest some more money into your marketing, right? Into the growth of your business, if you are doing consistently, 4% in dental supplies, 4% or even 5% in labs, right? You've given yourself a 2% window. Well, what could that mean, right? Well, if you're doing $100,000, 2% is $2,000. You can initially inject another $2,000 a month, right? If you're consistent on those savings to marketing, and now you're setting yourself up for growth and you're setting yourself up for success, right, down the road. And I think that's pretty unique if you're in a position to do that, and that's what these guys do.
Or yeah, you reinvest it back into like just training and team development, right?
Right.
You're saying about this. I like what you said about the space. Like, hey, your rent, what you want to be around 6% of your revenue, like your cost of your space, right? Your rent,
Right.
or if you have a mortgage, your mortgage
Right.
payment. And what's interesting about that, again, I was having this conversation just a couple of days ago with a client around on the employee side, is most businesses think, and you do want to run efficient, right? That's why you're looking at these numbers on a regular basis. You're setting goals. Hey, if my supplies are this and my lab is this and my employee costs and all this is this is what I should have left over in net profit, which is what I, as an owner, would need to then go do the things that I want to do, fund my personal goals, go grow, whatever. And what's interesting is when those numbers aren't like, oh man, I'm at 9% in my cost of my space, or my employee cost it's not 50%, it's 57% or 58%. I need to downsize. I need to fire some employees, or I need to downsize my space. Instead, what I would say is you can think that way. It's kind of that scarcity mindset of like, oh, I'm going to think if I can downsize to get the number where it is, versus what I would tell you is what most of these doctors and business owners do that are successful is they think, how can I use that space or those team members more efficiently and effectively to drive up the revenue? So how can I do more with what I have? Sometimes your space, you're stuck with that. Again, on a call yesterday with a client, they're in a 10-year lease. They have 9 years left in this lease. And they're like, how to get out of this lease? And I'm like, I'm not going to get out of that lease, right? It's really hard to get out of the lease. So instead, let's think about how can we maximize the space in order to drive more revenue so that percentage goes from 8% or 9% to 6% to 5% to 4% to 3% or whatever, right? That's the only thing that's going to affect that fixed cost, right? There's fixed costs in our business. That's one of them, right?
Right.
Is increasing the revenue. It's the only way to drive that down.
Right.
Same thing with employees. And again, I think about this group that you and I, we did a podcast interview with any of them. If any of you want to go listen to that, they're amazing. This 8 location group. And they talked about this around their team. They were like,
Mhm.
You realize that the only way to really have that team cost, how do you get the 30% EBITDA? Well, you get there because your team is so good and so efficient and so effective that their revenue contribution to the office offsets their cost so much that it drives down your expenses and drives up your EBITDA and your net income, right? And
Right,
so to
right.
your point, you're like, okay, good. You've been able to free up 1, 2, 3, or whatever percent on by cutting whatever expenses, labs, whatever. What kind of, and I'm super passionate about this idea, this concept around leveraging, right? Or like capitalizing on these opportunities in business. What could that 3% do if you reinvested into training your team, who then now your team cost, your employee cost goes from 50% to 47% to 45% to 43% because your team is more productive and contributing revenue at a higher rate to your practice, which is causing not your that overhead's not dropping because you're firing or letting go of people. It's dropping because the people you have are more efficient and effective,
Right, right.
right? And that's the piece that I think most of us, again, I've shared this story when I was early on in my career. I'd look at my overhead like every week and stressing out and racking up credit card debt and taking lines of credit against my home just to get my business started, right? And I was so fixated on the cost and the overhead because that was kind of the easy fix, right? Like, okay, if I just shave off $50 here, $40, which again, you should be efficient and easy. But I'll never forget, I had
Right.
a consultant and she goes, and it was Anne. She's like, Jonathan, stop all this time you're spending on focusing on cutting expenses. You could be focusing on going out and getting more revenue. And the revenue is going to fix that problem a lot faster than looking at cutting these expenses. The additional revenue is going to help you feel less stress and anxiety more than like, okay, I just saved $40 because I found out how to, this is going to date me, but how to go get photocopiers, copies made at like 10 cents each less or whatever it was, right?
Right.
And so again, I think a lot of times as owners, we're so fixated and focused on like, how do I cut overhead and expenses? And again, there's a certain element of that you need to be aware and tuned into what your expenses are. There's certainly waste. I think there's waste in almost every business. You want to always be looking through how you can run more efficiently. But as far as like, how do I get the needle to move in like these big swings? It's going to happen by reinvesting in your business, looking at what can you do to drive more revenue and make the space that we have more efficient and make the people that we have more efficient for us.
Yeah, look, I agree. I mean, it's just like it's a short little phrase, if you will, that I often say, just to our clients, just when in the exact same situation that you're painting. I say, hey, look, agreed. There's always an opportunity to look at expenses. There's always a little bit of fat that needs to be trimmed down, always, right? And I think you should always be looking at that. But focusing on the revenue, that's the long-term solution at the end of the day, right? Cutting expenses, you should always look for an opportunity to do that, but that's a short-term solution too, right? Let's say you look at your wages, and if truly you feel like there's too many people, right? Back to your point, am I using everyone efficiently? Yes or no? Right? Maybe you do have too many bodies, right? That's, very well could be a possibility. But if you focus on the revenue, then there's likely going to be an opportunity for you to deploy those employees, right, to revenue related efforts, right? And I think there's so much truth in that. And that if you focus on the revenue, use the resources that you have to go and grow revenue, then you're setting yourself up for success. You're giving yourself more opportunities, more options, right? So, anyways, kind of echoing your sentiment. I think it's easy to clam up and to play a little bit of defense when you're tight, but before you get there, I think I was speaking with someone earlier this week. There's up and down months, right? There's some
Right.
months that, right, like during the holidays, for example, right? We're on the back end of the holidays now, but well beyond the holidays. But like, look, January was tight for a lot of our clients, almost all of our clients. Well, let's talk about that. Okay, November, right? You had lower production days, right? People going on vacation, right? Team members going on vacation, patients. I'll speak, as a patient myself. I'll tell you the last probably 2 weeks of the month of November, I didn't want to go see the dentist because I wanted my teeth feeling good for Thanksgiving, right? And I wanted to be able to enjoy Thanksgiving, right, without having sensitive teeth or having work done, right? And so I didn't schedule, right? I'm sure I'm not the only one. So just from a patient perspective, right? So you're gonna have lower working days, and then you're going into Christmas, which also probably has even less working days. You have Christmas parties, you have end of year bonuses that you're paying out. So your expenses are staying the same, arguably going up a tad, right? Your revenue is dropping or your production's dropping a little bit more. And then in comes January and you're on the back end of back to back lower production days, right? Than you've had throughout the year. So you're stressed. We had clients that were stressed, right? We were stressed with our clients, right? Reviewing their cash flow with them. And so it goes up and down. But like before that, though, right? Maybe in your August, maybe in your October months, right? I think there's an opportunity, to be proactive during those successful months, right? Where maybe on those really awesome months, maybe you put some money aside for some of those lower production day months, if you will, right? I guarantee you, if right now, I know January and February has been relatively awesome for a large majority of our clients. So there's been a pretty serious rebound, right, in early 2025, which has been pretty cool to see. But look, keep doing what you're doing. Obviously, celebrate your wins, celebrate your victories. But, can you put some of that money aside for some of those, tough periods, for example, right? From a cash flow. So maybe you're not worrying about the stress, right? You're not as stressed out during the Septembers, right? During the holidays, during maybe the summer where historically, you've had a lot of associates or patients leave to go on vacation in the summertime or what have you, right? Is there an opportunity to do that?
I think that comes into also kind of what we are talking about at the very beginning, which is like on the forecasting, budgeting, having a plan, right? Because
Totally.
part of that forecast, you're going to see, in fact, our co-host Dr. Eric Roman talks about this with his practices that he had, which is that they just knew that because they saw the pattern, they pay attention to it, that, September was always going to be a slow month. They just knew.
Yeah.
And so you're like, so what if you knew what those slow months were in your practice months ahead of time, and you could start planning and preparing for those slow months? So you're like, hey, if I know that September is consistently a slow month for us, what could I be doing now in February or March or April to begin to prepare? Not necessarily like, oh, we're going to like cut back, but you could be like, hey, if people want to take vacation, maybe you encourage them to take it in September. Or if you're like, hey, you want to do a clear liner day and build it up in September, like back to school, whatever. Hey, moms, we have a client he's an orthodontist in LA. He was like, he goes, oh, I do that for moms on Mother's Day. I'm like, oh man, that's such a great idea. Do like a clear liner day where there's some sort of a discount or a benefit or whatever, where you're building up to one day, and you do that. And if you have multiple locations in those practices in September to help curtail that, so that's not a slow month, or put specials or do more marketing, or you start to think about and start to look at your practice as a business ahead of time, because you have the tools, the budgets, what those are, you're reviewing where they are. Are we on track? Are we off track or ahead of track of our goals that we set back in December for the year? And you're looking at it on a regular basis to see what modifications and changes you need to make. And what was cool, going back to this client we talked about earlier on, who has the 4 locations, who none of the practices were hitting goal, none of the practices were profitable. They were putting their own money in. Is now their consultants having a conversation with them about, hey, your practice is about to hit goal for the 4th month in a row, which they never did before. This practice doing about $260,000 a month. And they weren't doing it before. They're hitting it now. 4th month in a row. Let's now have a conversation around where do we go next with this practice, right? Which is a really cool thing to see. As we kind of like wrap up here, Austin, what are some, it's kind of like, so one of the things we do like at the end is want to go, okay, hey, if you didn't want to listen to the long two brothers rapping out over the last 30 minutes, like you can fast forward to this part of the podcast and get the top takeaways. So what are our top 3 takeaways for anyone who either did listen or maybe wanted to fast forward to the top 3 takeaway segment of the podcast?
Yeah, I think the 3 things, and I highlighted it kind of in the middle, are this. One, Are you reviewing your financials on a regular basis at least once a month? Yes or no? Right? Two, do you have goals that you've set for your practice on those KPIs? Right? Again, revenue, dental supplies, lab fees, marketing, payroll, rent, right? You could add
And
on net income if you wanted. Go ahead.
ultimately, I think you're saying like you should those KPIs or those budget numbers should be custom to you. Those
Yeah,
should be customized
absolutely.
to your
Correct.
practice or group of practices. If you want to start with like the industry averages at first, fine. But ultimately, you should have a goal to have those customized to you.
Correct. Correct. And look, it's okay if you don't know what those are. It's okay if you feel like maybe what you have is unrealistic. It's good to have a gut check every now and again and just see, hey, what are the benchmarks as of right now? It's good to know, right? So it's never a bad thing to look and see what those are and compare to what you have, right? And determine, is that realistic or not, what I have. So that's two. And then the last one is, are you being accountable to yourself? Are you holding others accountable to those goals, assuming that you have them set up, right? Because you could say, hey, I want to do 5% of my revenue on dental supplies. But if you're consistently hitting 7 or 8%, then, what's the point of tracking, if you're not holding others accountable at the end of the day. So those are the top three things. And look, we have clients that they know their financials so well, because they're reviewing on a regular basis these financials. I mean, we meet with our clients monthly and touch on these things per location every single month. And in areas where they're high, we drill in and we say, why was this high? Why is this? Can we go speak to the operations manager, Susie, or can we go speak to Jeff, the office manager, right? And ask, why this is high and why it's above, the budget that we set. Right. So, that's what happens, right, during our meetings. And then that's where you can involve the other team members, right? So that everyone is now, rowing in the same direction, if that makes sense.
Yeah. Awesome. So have a plan, budget, forecast, have a plan, make sure you're reviewing it regularly, minimum monthly. You should be in there every week. Again,
Minimum.
if you want best practices of how these groups that are crushing it are doing it, they're doing it weekly. They're in there looking at their cash flow, expenses, doing cash flow forecasting weekly, but you can certainly monthly. So have a plan, review it often. And then in that plan should be custom KPIs, key performance indicators, for those of you who don't know what that is, or just basically those percentages of like, this much percent for supplies, labs, all those percentages. And then again, tracking and reviewing those on a regular basis as well. So those three things, if you'll do those three things, that is what the top of the top are doing. And I'll just add this, again, this is probably a topic for another podcast, Austin, but it is so important as the owner of the business to make sure that you're getting paid and that you should be getting paid first. I know that sounds crazy. I know you're like, how does that make sense? And that as business owners, we always put ourselves last, right? My wife's always telling me you put yourself last. And that's something I always try and work on and try and be better at. But you certainly, and especially as a startup company, it's really hard to think about that. Or
Right.
as you're finding a second, third, fourth, fifth location. But you should make sure that you are getting paid. You need to be getting paid. And again, if you're not working with a group that is consistently giving you that information, reviewing those on a regular basis and making sure that you're actually getting paid, like Austin shared that example of that group that was not getting their management fee, 11%, pretty healthy management fee. And all of a sudden, it's like, no, we're going to make sure that gets paid first. And we're going to actually do it on a weekly basis instead of a monthly basis, because a lot of times they
Yeah.
have more money left.
Right.
All of a sudden, what happens? Oh my gosh, they start getting their management fee paid to them, which I'm sure we're like, there's no way this is going to happen, right? So again, it's designing it, taking action, getting in there on a regular basis, and really understanding and knowing your business and the financials around that. So, Austin, anything else to add before we sign off here?
No, other than you have your financials at your disposal, right? And you likely have a bookkeeper, right? Are you getting the most out of your bookkeeper, right? You need financials either to stay in compliance with your bank or your funding partner, and certainly to submit for tax purposes. The question that I ask is, are you getting the most out of those financials, or are you just kind of getting them to stay in compliance and just to submit taxes? And And
Yeah.
look, your financials need to be done one way or the other. Why not add that layer that speaks to you as a dentist and as a dental practice owner, right? And I think the more that you take your financials seriously, I can almost guarantee you'll see areas of improvement, and you'll find areas to open up your cash flow, and you will be a little bit more stress free, anxiety free, if you will, when it comes to your cash flow, the more involved you are in your financials.
Yeah, 100%. Again, it's just it's like it's one of those things where you're like sometimes we tend to overcomplicate things, right? How can I be healthy? How do I lose weight? It's like it's pretty simple. You just eat healthy, and exercise, right?
Yeah,
Like
yeah,
we tend to overcomplicate things a lot of times, and that's the same thing here. It's like how to run a profitable practice. It kind of boils down to these things that we're talking about here. So, Austin, how can people reach out to you if they want to reach you? And then number two is, do you guys do any kind of like complimentary financial review or any reports that you have that people can hit you up for and get a copy of like like a dental KPI report or budgeting report or anything like that?
yeah. Absolutely. There's a couple of ways you can visit us on at DSOCFO.com. The easy way to contact us there. There's also an opportunity to get updated benchmarks, right? So you can kind of see how your practice stacks up, those average practice benchmarks. I'm pretty accessible via email. That's amoffat@dsocfo.com. That's AMOFFAT @dsocfo.com. Pretty accessible there. Um, pr- Fairly responsive there. But yeah, in terms of compliment, look, we do free financial analysis. We're really big on that. We see it as an opportunity to introduce ourselves, and then B, let you know exactly where you stand, and and areas where you can improve on some stuff. So that's free. That's complimentary. That's something that we do. We do often for a lot of people, and it's an easy way to make an introduction, right? So we absolutely
Awesome.
offer those things.
Awesome. Well, thanks for being on here, Austin. Thanks everyone for listening. And I'd encourage you to reach out to Austin and get that complimentary financial review, or just even pick his brain on some of these best practices that we see working every single day in practice, and they work. So,
Yeah.
Austin, thanks again for being on here. And
Yeah. Thank you.
We'll talk to you later.
Thanks.
Thanks for joining us on Dental Wealth Multiplier. To make sure you don't miss an episode, go ahead and click the subscribe button. You can also visit us at dentalwealthmultiplier.com to get access to the links or materials mentioned in today's podcast. You can also see other episodes and get access to the most recent reports, tools, and information to continue your wealth building journey.